let's talk some economics here. There remains wide-ranging opinions on the momentum in the global economy, which is clearly battling high levels of inflation, supply chain bottlenecks, and of course, the ongoing COVID-19 pandemic. Fortunately, we have Goldman Sachs Chief Economist Jan Hatzius here to drill into all of this. Jan, always nice to see you. Thanks for coming on to kick off this week. Really liked your morning note. And the headline kind of took me by surprise a bit. It says, how fast is growth slowing? So let's start there. How fast is growth slowing in the United States, really because of a range of issues?
Great to be on. I would say growth is clearly slowing. Obviously, we're past the peak rate, but it's a relatively gradual slowdown. We're still growing at a pretty fast pace, pretty clearly above the longer term trend. We're at 3.25% for the third quarter. We'll get those numbers in less than 2 weeks. And then beyond Q3, since we're obviously in Q4 and looking into 2022, we think we'll be in the sort of 4%, maybe 4.5% range the next couple of quarters. And reasons for that still rapid pace of growth are, one, consumers still have a significant amount of cash on their balance sheets. Pent-up savings are significant. Number two, the pandemic is improving from the hit from Delta. And then number three, some of the supply chain issues basically mean that right now inventories are being liquidated. And as we go forward, we think production eventually catches up, and that's a positive force for growth. As we go through 2022, though, I think we'll see more of a substantial slowdown because a lot of these near-term forces are probably not very long lasting. So the second half of the year, I think, will be significantly slower.
Jan, you mentioned what's going on with industrial production. It's Julie here. We got industrial production numbers for September this morning, and we saw a decline of 1.3%. Of course, a lot of that has to do with what happened in the auto sector, a 7.2% decline in motor vehicles and parts as well. And I know that's something that your team is watching closely. So when you talk about the supply chain and production, really there are a lot of questions right now as to how long all of that is going to take to shake out. What is your estimation as to when we will see normalization of the supply chain?
I mean, I think things are going to get better. I think once we're in 2022, I wouldn't really expect a major change in the remainder of this year. Next year, though, as growth slows on the demand side, and as the COVID sort of disruption in the manufacturing sector moves further into the rearview mirror, we would expect a decline in the supplier delivery indices and in the various business surveys. I mean, that's probably the best near-term tracker of what's going on with these supply chain disruptions. We've seen, basically stabilization at very high levels in the last few months. Wouldn't really expect a major change on that through the end of the year, but then a gradual improvement as we go through next year. Because I do think that the strength on the demand side and the enormous amount of fiscal support that's gone to households has been an important factor in that. Obviously, that's diminishing. And we also should see a bit more of the spending from households flow into the service sector over time and a little bit less into the goods sector. All of that, I think, is going to reduce some of these pressures, but it's not going to happen quickly, I think.
Hey, Jan, it's Brian Chung here. I want to ask you about what the implications are this from a just raw inflationary standpoint, because people might not be feeling GDP growth, but they might be feeling inflation, certainly, when they go to the stores. You were talking about demand. When you take a look at the C component in the GDP equation, that might not account for what supply chain issues are restraining the ability of people to consume if the goods certainly aren't available, if the services simply aren't available to them. So what's your measure? How do you approach trying to measure the underlying demand? Because that seems to be the big story between transitory versus permanent, that whether or not demand is going to be robust even after these supply chain issues do abate. Do you still have some way of looking at that and parsing that out in your data?
I mean, I do think demand is, very, very strong at the moment, and total spending is well above total production. The difference between those two is inventory investment. Inventories are being drawn down right now because demand is so strong. I think as you go into 2022, demand is going to slow. I don't think it's going to fall, but I think it is going to slow significantly, and that is going to be a key factor for reducing the tightness that we're seeing at the moment. So very strong demand at the moment, but much less robust demand next year, because fiscal policy is going from a big tailwind to demand in 2021 to a significant headwind to demand in 2022, even if, as we assume, President Biden manages to pass a significant part of his longer-term fiscal package.
Yeah, when do you see GDP growth in the U.S. reaccelerating, and what's the trigger for it?
I think that's still a ways off, because we're still pretty close to these very rapid growth rates of the spring. The trend over the next year or so is probably going to be downward. Late 2022, early 2023, we think we'll be growing at 2% or a little bit less. That, I think, is going to be a temporary air pocket, driven by the payback for the fiscal support. Subsequent to that, our baseline forecast has some reacceleration. I mean, I would caution that obviously there are lots of different factors out there. There have been many curveballs in this recovery. So my confidence, especially as I go out this far in the forecast, is relatively low.
Yeah, that makes sense given the unpredictability of this cycle thus far. One other area that has been maybe a little bit tricky to predict is the housing market. And we just got other numbers on that U.S. homebuilder sentiment rose to a 3-month high in October. You guys have been predicting the increase in housing prices, and you say prices are going to go up a further 16% in the U.S. by the end of next year. What effect, in turn, is that going to have on economic growth? On balance, is that going to be a contributor, or is that going to be a limiter if people are not able to afford those homes?
Well, on balance, I think it's a contributor, probably. I mean, at least on the consumer side, because you're probably adding a bit to the wealth effect. I don't think it's going to be, a massive impact. Typically, the wealth effect is measured in a small number of cents on the dollar, maybe 3 cents, 5 cents on the dollar of additional housing wealth. But I think you make a good point that on the home building side and on the home purchase side, these high prices do seem to have an impact on how people think about whether it's a good time to buy a home. I mean, there are survey results that say a pretty small share of the population now thinks is a good time to buy a home. And, under our forecast for what happens to house prices over the next year, that is probably going to get worse, not better. So there could be some offset there. In general, I don't think that housing is going to be, the main swing factor on the ups and downs of growth. I mean, it's really more the factors I talked about earlier. What happens to the virus, near term, probably positive, pent-up savings, and the inventory cycle and supply chain issues. Housing is probably below those 3 factors in terms of importance.
We've heard this S word thrown around, stagflation. Would you describe the risk in, let's say, 2022 or 2023 for U.S. economic output and unemployment and inflation to look like a stagflationary environment? If not, is there another type of portmanteau that you would suggest to describe what we should expect to see in the next few years?
So I don't think we're in a stagflationary environment now. Obviously, inflation is much higher than it was and much higher than most forecasters expected. But growth is also pretty robust at the moment. And I think you can see that in a lot of different indicators. So the stag part of it isn't really operative. Going into next year, I think growth, at least if you go into the second half of the year, is going to be a lot weaker. So the stagnant part maybe you would subscribe to. But I also think inflation is going to be a lot lower, because my view is that a significant part of the strength in inflation is quite temporary. It's basically driven by this upward pressure in the goods sector for a variety of reasons. We think that's going to come off. So goods prices, used cars, and other areas like that are going to go from being a major positive contributor to inflation to probably being a negative contributor. And I think that's going to take you down to numbers much closer to the Fed's 2% target. So I would say it's going to feel a little bit more like a traditional cyclical deceleration in growth, because growth is going to be weaker, we think. Inflation is going to be lower. Of course, we're also going to be much closer to full employment, so it's not necessarily a bad thing to see slower growth, but it's going to feel more like a traditional slowdown, I think.
And yeah, we recently talked to your colleagues over on the energy team, and they're clearly looking for higher oil prices. At what point, what price would oil prices really start to lead to demand destruction on the part of consumers?
Well, I mean, I think it's a negative factor now, because you are cutting into disposable income if you have to pay more for a given amount of energy consumption. So I don't think there's necessarily a point below which it doesn't matter and above which it matters. I think it matters now. It's not been a sufficiently large hit to derail the consumer recovery, and we saw that in the September retail sales numbers. But at the margin, I think it does contribute to deceleration. And the U.S. has so far not been hit as hard as some other places in Europe or Asia, where energy prices have been a bigger issue. In China, it's been a significant issue. In the UK, it's been a significant issue. The US so far has gotten off somewhat more easily, but it's a drag nevertheless.
I am hoping for a warm winter, no doubt about it. Jan Hatzius, Goldman Sachs Chief Economist, always nice to see you. Have a great rest of the week.
And with me to talk to you about everything to do with malnutrition is Abbott's Executive Vice President of Nutrition, Daniel Salvadori. Daniel, absolute pleasure to have you with us today. Obviously, a really big announcement from Abbott, partnering with Real Madrid, a well-known Spanish league soccer team. So this is obviously a big deal announcement, but underlying it is a very serious topic, which is malnutrition globally. Tell us a little bit about how this partnership came to be.
Thank you, Anjalee. Good morning to you, and really happy to be here today. We believe that a sustainable future starts with good health, and good health starts with good nutrition. And that's frankly especially true for kids. Yet 1 out of 5 kids worldwide is malnourished. And unfortunately, there is very little awareness about this issue. So today we announce a partnership which is the first of its kind, really, between Real Madrid and Abbott. At Abbott, we have been focusing on malnutrition for quite some time, but what we are endeavoring to do and really striving to do here with the Real Madrid is help identify, educate, and support the need for malnutrition for kids worldwide. So I'm really excited about this because I think together we have a huge opportunity.
Absolutely. And it's something that hasn't been discussed as much. I want to talk about Abbott's role in this, though. Clearly, you've had a lot of focus on nutrition. Pedialyte, of course, we know is the big brand there. How do you plan on moving forward with this partnership? Does it help to elevate Abbott's nutritional segments? And what are the plans to leverage this?
Yeah, so it's a great question. First step is we want to really help identify the need. So help screen kids, starting with the school and the clinics that Real Madrid is operating in 80 countries around the world. Because very often the problems start with the lack of awareness. Then further down the road, we also want to help think about new product. But first of all, we need to understand the issue even better and then find new product and new solution. Today, you mentioned Pedialyte, definitely one of our key products for rehydration, but not the only one. Abbott has been in the business of malnutrition for quite some time, with some solutions which are well known, and you may know some of the great brand, and some other that are less known. But we have a heritage of 130 years of healthcare. And we put a lot of science and a lot of years of studies in all of our product because we believe in the power of science behind the nutritional product we provide.
I spoke about this with CEO Robert Ford recently, just the idea that Abbott has become this sort of well-known brand at home, much more so than in the past. Do you see this playing a role as well, especially overseas, in sort of reinforcing that? And do you think that this partnership is a result of sort of the elevated presence that Abbott has had throughout the pandemic?
Absolutely. Look, I mean, kids have suffered throughout the pandemic, perhaps more than anybody else. But we know that soccer is a universal language, and soccer teaches us that we can all believe, we can all dream. I think, kids' dreams are probably the most precious one. But for those dreams to become a reality, we need to provide kids with the proper support so that they can develop and become the best they can be. And I think Abbott is really a great platform. We have a unique mission. We have, as you know, 4 businesses. We help, screen, identify, diagnose diseases. We treat them with devices, with pharmaceutical. But nutrition is really the bedrock foundation of good health. That is true for adults, but that is so much more true and important for kids. So I think with this partnership, we can really help realize those dreams and help support kids worldwide.
And lastly, a lot of conversation around soccer here in the U.S. now with the prominence of the show Ted Lasso. I just wonder, do you think that this will also help bring more awareness to the sport here in the U.S.? Because obviously this is a bigger deal abroad.
Absolutely. Look, I mean, again, sport is a universal language. And the first step in the fight for malnutrition is creating awareness. So I think sport can help boost that awareness, which is really the first step, is being aware of the issue and then tackle it all together. I also love the fact, and here we're teaming up, great brand, great companies, great group of people from the private, the business sector, trying to help the kids, trying to help the world become a better place.
All right, well, we'll have to leave it there. Daniel Salvadori, Executive Vice President of Abbott's Nutritional Segment. Thank you so much for joining us today. Really appreciate it.
Welcome back to Yahoo Finance Live. It's been about a decade since he left his post at Apple, where he was the creator of the now famous Apple retail stores. But Ron Johnson is back today with his baby Enjoy Technology making its public debut as shares pop by about 3%, the company looking to forge ahead in the delivery space with some key differentiators, including the fact that they're going to be treating their employees, as salespeople out there to upsell as they make deliveries, including iPhones out there. So we are coming full circle. And for more on that, very happy to bring on the man himself, Ron Johnson, Enjoy Technology's CEO, joins us here alongside Yahoo Finance's Brian Sozzi. And Ron, congratulations on making this one public here, coming public via a SPAC deal. But talk to me about the growth that you see here as you see it kind of unfolding in the delivery space, doing something differently.
Yeah, the delivery space has been rapidly changing. It's all about speed now to the door. And a lot of people can deliver a product. We deliver the whole store. Most people are focused on getting to the door. We go through the door. So we operate as this network of mobile stores. Imagine your city with a network of vehicles running around filled with inventory, operated by a full-time employee who's trained. Imagine, one of the people at the Apple store who can deliver a retail experience on demand, not just a product delivery. And so we look at as commerce moving to the home, and now you can have an experience at home versus in the store. And it's just another great choice for people who want to buy a new product.
Ron, how difficult has it been to build out this model in an environment where we're seeing worker shortages? And there's a pandemic out there, and it's hard to let people you don't know through that front door.
Well, like everything, there's two sides to every coin. The challenge is the pandemic. You've got to prioritize safety first. And so we had to adapt our model. But the other side of the coin is online shopping is going through the roof. And I think that's permanent here to stay. So we've successfully navigated through this. We shut down for 3 days when the pandemic started, got some new protocols, and we took off again. And so we operated all the way through the pandemic with super high NPS scores. We're at lifetime at 88. So customers love the experience, and the pandemic was no different because people still need their products. They need help. We just had to figure out how to deliver it during a pandemic.
Ron, this whole discussion is so fascinating to me because it feels like we're kind of in this day and age where everything is, one day immediate. The expectation is to have it delivered to your door. It sounds like you're saying that things are going to be experienced more at home in retail moving forward. And yet, I have to admit, this weekend I went out and actually walked into a physical store. I shop a lot online, but it actually felt nice to see the products right there.
Hey, I did that too. I love going to stores. I'm here in New York. Yesterday, I went to some of my favorite stores. Stores are a huge part of our future. They always will be. In many ways, I think they'll be the biggest part. But at the same time, people are all starting digitally. And the reason you go to a store a lot of times is I want to try a product or get help. We now do that in the home. So we bring the entire store. So with a partnership like Apple, we actually bring new products you can try in the home to demo. And then you can buy them because we have them with us. And so we're just taking that entire retail experience, everything you do in the store, and bring it to the home. It's been really hard to figure out, but I've enjoyed spending 7 years with my team, solving this puzzle.
Yeah, it's been an exciting thing to watch. I mean, you talk about the growth here, pretty ambitious, plans to reach $1 billion in sales by 2025. He did $109 million last year, up from $15 million in 2018. I mean, talk to me about how you get there. Is it all just leaning into tech, or do you see this expanding beyond that?
No, we're going to get to that number just with, a handful of partners. So one unique thing about our business model, we operate stores for some of the world's largest companies. We started with AT&T. We operate mobile stores for AT&T. We operate in the United Kingdom for British Telecom. In Canada with Rogers. We picked the smartphone because it's kind of the center of our digital life. A little over a year ago, Apple, launched Enjoy, so we operate stores with Apple. And so we don't have to go acquire customers. We just got to earn a higher share of their shopping cart. And as people learn about the company, they have to make a very simple choice. Do I want this product delivered to the door, or do I want some help and have it go through the door? Both ways it's free. One, you get an experience. One, you get a transaction. We think a lot of people are going to vote for an experience.
Ron, who do you see as your competitors?
Honestly, we don't have one. There's nobody else trying to do it. It's really hard. We spent 7 years building the technology platform, the infrastructure, how to manage inventory mobily. So think about it. The companies do ride sharing. I could take my car, put in an Apple map, and go deliver someone to wherever they want to go. We've got to triangulate people, inventory, availability, length of visit, to book appointments. And we've done appointments in as fast as 15 minutes. And in fact, my ambition long term is to be able to get a store to you faster than anybody can deliver a product. And we think we can do that because we have inventory mobily in the marketplace. It's not at some fixed warehouse. It's always on the go. So when we have availability, it's how close we are to you. So this is meant to be a retail store on demand, which I think is a really big idea.
Ron, it's not lost on me. This is your third act. Apple, home run, JCPenney, a little more mixed. Who is Ron Johnson, the leader today?
Oh, I think I'm probably wiser than ever been. I learned a lot early in my career at Target. I started my career, came out of Harvard Business School, unloaded trucks at a Mervyn store in California. I grew up at Target, learned merchandising. At Apple, I learned the whole retail experience. At Penny's, I learned, I'm not the kind of guy who does a turnaround. I'm a builder. So I went and said, what's a great idea? And I said, I'm going to build a new channel, the mobile store, to reinvent online shopping. And that's what I've been doing for 7 years. And so I think I'm wiser, I'm more experienced, and I'm having a blast.
You may not be the one, Ron, in your opinion, that orchestrates the turnaround, but you've got some pretty good insight across retail, just having been in so many different companies. What's a company, or what are some retailers you're looking at today that you think could suffer the same fate as JCPenney because of their inability to adapt?
Yeah, I think right now is a really interesting time. A lot of stores are doing well because the consumer's back, they're going to malls, they have a lot of money in their pocket. When we get to spring, when all of that wears down, we get back to normal, we'll get back to the same challenge. And so what retail people don't like is what I call tired retail, where the store feels like it hasn't been updated. There isn't good service. The products aren't inspiring. People gravitate to new, exciting places, just like we like new, exciting products. So retailers that aren't updated, that are in bad locations, will struggle, and it's really hard to turn around. That's what's interesting about retail. It's always moving forward. In my career, I saw the big box channel emerge. I saw outlet malls emerge. I saw online shopping led by Amazon emerge. Now I'm in the forefront of the next wave, which is bringing the store to you. But that's what's fun about retail. It's always changing, but you got to stay ahead or you will fall behind.
It's a very interesting concept. As you said, no competitors here, so we'll see how it goes as you move forward in that space. Enjoy making its public debut. Ron Johnson, appreciate you coming on here to chat with us today alongside Yahoo Finance's Brian Sozzi. Be well.
Welcome back. The supply chain crisis, it seems to be getting worse with each passing day. The ports are clogged with ships filled with goods and supplies, but transportation issues on shore are grinding deliveries to a halt. New data out by Flexport shows there is no sign that the U.S. consumer will be slacking in purchasing their goods this holiday season. Joining us for more is Phil Levy. He is chief economist at Flexport and also Yahoo Finance's Danny Romero. Phil, thanks so much for being with us. So let's dig a little bit deeper into your findings here and tell us when you think we might see this backlog finally start to alleviate.
I think if you're looking for when are we more confident that relief's going to come, it's a ways off. This might be as long as the beginning of 2023. There's a big backlog and it's a mess.
And Phil, also another thing, we've seen like a record number of people leave their jobs. And obviously the president announced last week that, the ports in LA and Long Beach were going to expand their hours. Where are all these workers going to come from?
Yeah, that's a real question. I think that there's a challenge through a bunch of industries. You've got labor questions, inflation. It's that this whole, one of the things we've really seen, if you look at the economy in this COVID era, has been doing major reshuffles is just hard. And we've seen that all up and down the supply chain.
Yeah. And, they keep talking about the truckers, right? The people on the ground. And I guess my question to that is, when are we going to start seeing people come back to work?
I think on the come back to work side, that you're asking the million-dollar question there. And I think this is part of what the Fed has been hung up on is, do we have an economy where really the people who want to be employed are employed and we're seeing fairly low unemployment numbers? Or do we look and say, yeah, but we have nowhere near the jobs that we had before the crisis? And so the latter leads people to think, well, there's an army of workers who are ready to come back. We know from studies that there's a number of things out there that are holding people back. How easy is it to get childcare, for example? How do they feel about the health situation? That's what we're all watching, is to see that as some of these things are resolved, can we unstick some of these obstacles? Or is this the great resignation where people have just left the labor force? I have some answers about consumer demand. I'm not sure I know what's in people's minds about returning to work.
I want to talk about consumer demand, Phil. Do you think that all of these problems with getting goods to consumers is actually going to dissuade people from buying, especially some of those big ticket items? We know how difficult it is now to get appliances and things like furniture. So going forward, do you think consumers, unless it's an item they absolutely need, may they hold off on some purchases simply because they don't want to have to deal with the headache of the supply chain issues?
Yeah, I think that there's some of that, but this is this is like that old, I think it was Yogi Berra says, no one goes to that restaurant anymore. It's too crowded. People may hold off, and you see surveys when people are asked, this is a good time to buy or not, and they say it's a bad time to buy, but an awful lot of people are buying. And that's what we've been trying to track, is underlying a lot of this crisis. What you've had is two things. You've had people with a surprising amount of money in their pockets. We didn't see incomes go down like we normally see in a recession. And a really dramatic shift towards purchasing goods. We're still a services economy, but much less so than we were. And that's what's driven this. So you're absolutely right. It's not easy, and that may dissuade some people at the margin, but those preferences, we're not seeing them change.
And Phil, going back to the report that you released about the post-COVID indicator, you mentioned slacking, which is just such an interesting word to use for a consumer, right? What do you mean by that? And I guess how much of a bigger jump will we see in the next few months?
So let me explain what this is. We all know that there's been craziness around supply chains. The real question is, how do you quantify craziness? What does that actually mean? So the thing we looked at is what I just described. How far are we off normal in terms of consumers' demand for goods rather than services? And I should note that what we had before normal was fixed for a very long time. This was almost a behavioral constant. What the numbers that you were just showing indicate are where are we essentially relative to the craziness of summer of 2020. What we're forecasting is through the end of this year, according to the Flexport platform data, there's no sign of a let-up in this very strong additional preference for goods. And as long as people have that preference, and as long as they got the money in their pockets, we're going to see a lot of pressure on the supply chain.
Turn your attention now to the housing market. And we've seen home prices could surge 16% by the end of next year. That's according to a report by Goldman Sachs. That's after a rise of about 20% this year. But inventory shortages and unaffordable prices have bled into the rental market. And here to help us discuss that is Igor Popov, Apartment List Chief Economist. Thank you so much for being here, sir. And I've seen the rents go up myself because I rent in the city and moved just at the beginning of the year. So I've seen the prices skyrocket from January up to now. It's still a white hot market. The edge has been coming off a little bit, but we just got NAHB numbers out today, and building sentiment is still high. We expect to see sales go up. How does that gel with what you've seen in the rental market over the course of the pandemic and where we go from here, because shelter inflation has skyrocketed?
Absolutely. There have been a number of twists and turns really throughout the pandemic. But if we just look at 2021, you're absolutely right. We've seen that across the board. We've seen rents skyrocket 16.4% just since January alone in our data. And for a little bit of context, in a normal, more typical pre-pandemic year, the average growth was only 3.4%. So the market is already in a very different place than it was when you signed your lease at the start of the year. And the thing to note is that this isn't about a few hot markets, and it's not about demand shifting from one type of market to another. These are really rent rises across the board that are driven by strong demand and limited supply really across the entire United States.
And certainly housing prices, they tend to move, I guess, slowly, but once they go up, they tend to stay up for a while. Is there any indication that these higher rent prices might be transient, to borrow a word from Fed Chief Jay Powell?
Right. I think it is unlikely that they will come down, but at least the car will sort of probably press on the brakes a little bit, because I think the rent will actually slow. It almost has to with the breakneck pace that the market has been headed. But we're really starting to head into slow season. It's important to remember that the apartment and rental markets are very cyclical. Most people move in the summer. That's when we see rents really climbing their fastest. And we usually see a bit of a cool down, especially as we get into the colder months and especially in more seasonal markets. The wild thing, though, right now is that in a typical year, again, rents should fall in October as landlords and properties are trying to fill those last few vacancies that they weren't able to fill in busy season. But we're seeing quite the opposite. We're seeing a slowdown from the summer, but that's not saying much and not a lot of really not very reassuring to many renters, because we're still seeing about a 3.4 month over month growth in the cost of new leases throughout the United States. So I think that, just to summarize, a seasonal slowdown means something a little bit different this year. It doesn't mean rents falling like they typically do in October, November, December, but it means at least rent growth slowing down. So certainly the price changes are there to stay, but the rate will cool from the breakneck pace it was on this summer.
I don't think there is a seasonal slowdown this year, to tell you the truth, from what I'm seeing. But tell me, I know you say that nationally the prices are up across the board, but there are certain regions that have seen surges in prices, right, away from metropolitan areas. Can you tell us about some of those shifts? And do you think those regional shifts where people are moving to maybe for more space are a permanent thing that we'll see, or will people start to migrate back to more metropolitan areas?
Well, it's interesting. What we saw in 2020, especially as the shelter-in-place era began and people kind of went into lockdown, was really a tale of two Americas when it came to the housing markets. We saw very, very fast declines in demand and subsequently rent in some of the hot, expensive coastal job centers, the San Franciscos, the New Yorks of the country. And we actually saw a surge in demand in a lot of smaller and more affordable markets that were growing, but saw a totally new era of rent growth. Places like Boise, Fresno, Tampa, Florida, the Phoenix suburbs. And so 2020 was about convergence, I think, where the expensive places got a bit cheaper and the affordable places started to really heat up. What we've seen in 2021 so far is essentially both of those types of markets growing quickly. So it's both true that the New Yorks and San Franciscos and Seattles of the country are rebounding quickly. In fact, just a couple of months ago, New York City led the nation in our data for month-over-month rent growth. But what's happening in some of those smaller markets with a bit more room and a bit more affordability is that they're basically piling on a year of very fast rent growth on top of a 2020 that already brought a lot of rent growth. So places like, again, Boise, Spokane are leading our data, Tampa, Florida, in terms of the just immense rent growth that they've seen that traditionally would only be reserved for a small market where someone found oil or something like that. They've seen rent growth over 30% year over year. So we are seeing flow back into cities. We are seeing kind of the expensive urban demand coming back. But I do think there's a real shift that's come from, really a renegotiation of remote work that's happening throughout the country that's going to have a massive effect on the rental market, even as we go into 2022 and beyond.
Igor, speaking of that demand coming back to major metropolitan cities, during the depths of the pandemic, we saw landlords throwing everything plus the kitchen sink at would-be renters, lots of benefits and cheaper rent to entice them to come back. Have a lot of those incentives just dried up now and rent prices are continuing to move higher in those big metropolitan areas?
Yes, that's exactly right. Largely speaking, you may get lucky, but as a matter of principle, mostly the concessions are gone by this point. And the pandemic rent deals are mostly gone. We basically, in our data, we have only 5 medium to big size cities that still have rents at a lower, that are cheaper basically than they were at the start of the pandemic. That's San Francisco, Oakland, San Jose, DC, and Minneapolis. And even there, they're catching up and still growing very quickly. So the sweet spot, the luckiest renters in the country are those that signed their leases in January or December of last year in some of these markets that did see rent drops. But again, there's this whole other set. In fact, most markets, they never actually saw those rent drops even in 2020. But those premier coastal job centers, they saw both a quick drop and a quick recovery in 2021.
I feel like I hit the jackpot because I signed my lease in February, so I was lucky. I got
exactly.
a good deal.
Yeah, so I don't tell too many of your friends. A lot of envious people for that lease right now.
We will have to leave it there. Igor Popov, Apartment List Chief Economist, thank you so much for your time. And joining us now for more analysis is Ray Wang, Constellation Research Principal, Analyst, and Founder. Thank you so much for being here, Ray. What stands out to you about all these products, and do they live up to the hype?
I'm just impressed, right? I mean, we're breaking Moore's law. We're bending the power performance curve that's actually been going on in computing for some time. And if you see what's going on here, I mean, short of mining Bitcoin on these machines, I mean, the M1 chips are pretty much, performing, and people are going to put them to the test, right? A lot of it's the AI, the ML on the back end, and what people are really excited. So I think it was the MacBook Pro, of course, stole the show, but you can't do it without the M1 chips. And I think what people were excited about is the 1080 camera camera. Finally, a better camera on the MacBooks, better mini LED display, and of course the MagSafe is back, and an SSD card, which is what people have been looking for. For folks who like the touch bar, the OLED bar, that's gone. It's now back to function keys, and I think that's going to be interesting. But from a financial perspective, right, Macs are 10% of Apple's revenue, right? We're talking about $8 billion. They grew 16% year over year last quarter, and this is going to be in the refresh cycle. We think somewhere between 28 to 29% of MacBook Pro owners are going to be in the middle of a refresh, and there's a lot of reasons to do that refresh.
Do you think, though, that it's going to be a game changer? I mean, did you hear anything today, Ray, from Apple that makes you think, you know what, they're really going to be a contender here this holiday season?
I really like the HomePods, and at HomePods Mini at $99, and the way they're integrated with Siri, the touch, it's a lot of the home automation people have dreamed of, and being able to tie it back to what's going on with Siri, what's going on with the Apple devices. I think that's going to be a surprise sleeper. It might be the stocking stuffer for the year. And the other thing that was interesting was really what you're seeing with the AirPods, as people were talking about. I think the whole complete lineup of AirPods now has that thing in the middle, which is the AirPods 3, which is important. That spatial audio, it makes a big difference for those who've had a chance to look at Dolby Atmos and get the feel for spatial audio, be able to see everything in 3D. It's a different kind of experience. And of course, I mean, the MacBook Pros are enough for an upgrade.
And Ray, tell me, so many of these gadgets, they're really wonderful. How many of them will actually end up under the tree? Because we're already hearing about supply chain issues, right? We heard that Apple would be slowing its production of iPhones. The lines are incredible. The wait times are incredible. They're going through January. So how many of these items do we actually see showing up for the holidays, do you think?
From what we understand, these items are available. If you order today, they'll be available next week in stores. So we'll have to see how the supply chain and the demands get matched. As you know, the chips for the M1s are coming from TSMC. So I think they've had, they've been able to get these done and produced on priority. But, for the other objects, like for the AirPods, for, the HomePods, I think they've been in good supply. So we'll see what happens. We'll see what the order lines look like. But yes, the iPhones have been slowed down in as much as 3 to 4 weeks from what I can hear.
And I would like your take on this Apple Music voice plan, $4.99 a month. Yet another thing we have to shell out for at the end of the month. We don't realize we need these things until Apple, I guess, tells us we do. But what do you make of this offering? And is this really going to incentivize people to sign up?
I think so. I think a lot of people, I mean, we don't go out and buy, I mean, we're dating ourselves. Like people don't go out and buy CDs anymore or, go out and download MP3s the way people used to. And so subscription services have pretty much been the norm. And a price point of about $60 a year is simple. And the family plans that are also being announced as well, I think make it a lot easier for folks to, it's a simple gift for someone, or it's something for people like to have music everywhere. And plus, if you've got the HomePods running and if you've got, if you've got the HomePods running, and if you got a brand new MacBook with 6-speaker audio, that's you're definitely going to want to take advantage of that. So.
And Ray, I believe Google and Samsung are also coming out with product launches later on this week. How do they all stack up to each other? Does Apple, by far and away, lead the game here, or are other technologies from these other players also in the mix?
We're definitely in a competitive market. Apple definitely has the leads on phones. They're trying to get into the home market. Google and Amazon have done a good job getting their devices and their speakers and their smart speakers into a home market. So I think it's highly competitive. Most of it really comes back to operating system. You're either on iOS and you love it and you want it fully integrated inside your home, inside your car, at work, or you're going to go down the Google route and take it all the Google features along the way. And then of course Amazon's got a great presence. So you're definitely going to see those three, go after each other pretty hard. So Samsung being part of the Google ecosystem and Hyman being a Samsung company, I mean, they're definitely looking at, different ways to actually penetrate the home market as well. So it's highly competitive. And I think it's for the same reasons, people really like, their Android OS versus their iOS versus what's going on in Amazon. I mean, it's all in preference. So it's content, it's preference, ease of use, and of course, the coolness of the device.
We do know, though, by Apple's own admission, that it has been impacted by the computer chip shortage, and in fact, it had to cut production of the iPhone 13. Do you think that that's going to cause problems here when people try to get the phone for the holidays?
I think so. If there's the demand, I mean, this is the super cycle. We expect 249 million phones in the super cycle, and the chip shortage is definitely going to hurt. We see a lot of companies like Apple. I'm not sure if Apple's doing this. Charter their own cargo, charter their own planes now to be able to get the chips in place. It's not just a supply issue. It's also the supply chain on the back end. Parts aren't getting delivered, and that overall supply chain disruption is everywhere.
All right, Ray Wang, we will have to leave it there. Constellation Research Principal Analyst and Founder. Thank you so much for your time.
This issue of getting the parts you need, if you need a tire for your combine or some piece of equipment, does your software help them in that regard? Or are there ways to streamline that?
Well, specifically the software not, but what it does is understanding how the market is moving and how the market has moved for the last 25 years will allow the farmers to understand when to go for the parts so they don't get inventory to sit on it because it's cash sitting on the deck. So it will help them understand the production worldwide and how it impacts them locally, even in a local farmer in Detroit, for example.
Martha, give us a sense just of what you're hearing. I guess how prevalent is this supply chain issue and how many farmers that you're dealing with day in and day out or that you hear from on a weekly basis are struggling as a result of this?
Oh, definitely. In the last, it wasn't that bad the first, even believe it or not, the first 3 months of last year when we went to this pandemic, because we thought it was going to be just a little bit and then we will go back to normal, but not longer is normal. So the farmers are continuously concerned that there's not enough trucks drivers, there's not enough parts, there's not enough trucks to take to the ports. So it's a whole supply chain that it's impacting everyone. And especially, as I say to people, once you plant up a strawberry or you plant anything, you have only so many days or weeks to be able to ship that out. And that's what you are dealing with as farmer.
I would imagine, too, that the data and the software that you provide for farmers, that they don't have to operate necessarily just-in-time inventory, is what I hear you saying. And yet some of these supply chain issues, is part of it panic buying on people who are stocking up because they fear they might not be able to get it in the future?
The reality is that the supply chain has been impacted all along for the last 40, 50 years. Those of us who have been in the farming world have known this. It was just a matter of time as the world will realize it. But we have been always work in the very thin line of potential disruptions, whether it was an earthquake, whether it's a war, whether it's a trade war between two countries. There has always been, is that this became exponential for everyone. So definitely what it does is the market, the whole world market, impacts everyone and starts clogging the systems in different parts of the world. A problem between Taiwan and China on a pineapple expands to Costa Rica and United States and Philippines, and even Kenya and the Middle East. So it is really now we're so tight, the globalization is so tight that now all the farmers have to play in that playground, which is the world globalization.
Martha, you have almost 30 years of experience in this, in food and agriculture and supply chain. So from your perspective and from your experience, what is the best way, what needs to be done to address these issues that we're seeing today?
I think the number one is for buyers, specifically our buyers across the world, to start getting more educated on what's the production of the world and when production happens. We have been continuously researching what the consumers want, but nobody has really done a report of what the earth produces and when it produces. And I think once the buyers start understanding that, they will adjust to buy when there's enough and not buy too much when there's not enough, and pass on to the consumer to explain that, hey, you can only have strawberries certain times of the year, you can only have some parts. And I think consumers will be responsible enough to understand that that's what they're going to buy and that's all they're going to get, and focus on that.
Do you think we might see, though, the prices that are going up not come down? I ask this because I use what I call the black bean index. I buy black beans all the time. I'm paying $1.49 for one brand. Used to be $1.29, and they grow this stuff in North and South Dakota. So you just said, oh no, prices won't come down. Why not?
No, they will definitely not come down because definitely the cost, number one, labor across the world. It's not just United States. I can tell you around the world, different countries are having the labor issues. Young generations are not staying in the farm. They're not motivated to stay in the farm. The second part is the inputs, everything that we have to produce for them to be used. And remember, many of us are going very organic, and that requires a completely different set of inputs. So it's not going down, definitely. We're going to stay, and if we might go a little bit higher for a while.